If you're retired or close to retirement, there's a headline you may have seen that sounds almost too good to be true. The IRS announcing a $47,500 senior deduction. That number gets attention fast, and for good reason, because for many retirees, taxes feel like a constant squeeze. So the idea of a massive deduction sounds like relief. But here's the problem. Very few people understand what that number actually represents. And even fewer understand the hidden Medicare issue that can quietly cost retirees hundreds of dollars every single month. So today, we're going to slow this way down. No hype, no technical jargon. Just a clear explanation of what's real, what's misunderstood, and where retirees accidentally lose money without realizing it. Let's start with the headline itself. The IRS did not suddenly create a brand new $47,500 check for seniors. That's not how this works. What people are reacting to is a combination of existing tax rules, age-based provisions, and how income is counted for retirees in 2026. When those pieces are stacked together, some seniors can reduce taxable income by a very large amount, but it's not automatic, and it's not free money. It depends on how your income is structured. Now here's where things get tricky. Reducing taxable income for IRS purposes does not always reduce income for Medicare purposes, and that's where the trap lives. Because Medicare doesn't care about deductions the same way the IRS does. Medicare looks at a different number, and when retirees don't realize that, they're shocked when premiums jump, sometimes by hundreds of dollars per month. So let's build this from the ground up. First, let's talk about what people mean when they say senior deduction. There is no single line on the tax return labeled Senior Deduction $47,500. What actually exists are several tax rules that add up when combined correctly. These include the standard deduction, additional age-based deductions, income exclusions, and how Social Security is taxed. When you put all of these together, some seniors effectively shield a very large portion of income from federal income tax. That's where the big number comes from. But again, that's for income tax, not Medicare calculations. Now let's talk about the standard deduction first. In 2026, the standard deduction is higher than it was just a few years ago. This alone removes a large chunk of income from taxation before taxes are even calculated. On top of that, seniors over a certain age receive an extra deduction. This is automatic if you qualify. You don't have to itemize. You don't have to apply. But here's the important part. The standard deduction reduces taxable income. It does not reduce the income number Medicare uses to calculate premiums. Those are two different systems. Now let's bring Social Security into the picture. Many retirees believe Social Security is either fully taxed or fully untaxed. Neither is true. Social Security taxation depends on something called combined income. That includes other income, tax-exempt interest, and a portion of Social Security benefits. With careful planning, some retirees pay little to no federal income tax on their Social Security, and that contributes to the idea of a huge deduction. But again, Medicare does not look at this the same way. Medicare looks at modified adjusted gross income. That number often stays high even when taxable income looks low. And this is where retirees get caught off guard. They see a low tax bill and think everything is fine. Then Medicare premiums rise. Now let's pause here, because this is the moment where many people say, wait, how can I owe less in taxes but pay more for Medicare? That feels unfair. But it happens all the time. And unless someone explains it clearly, it feels like a penalty. In reality, it's a mismatch between two systems using two different measurements. Now let's talk about that $300 per month issue. This usually comes from Medicare income-based premium adjustments. These are not fines. They're not penalties. They're tiered premiums based on income levels from prior years. And here's the painful part. The income Medicare uses is often from 2 years ago. So retirees make a move thinking they're saving money, and the Medicare bill shows up later. Now imagine this scenario. A retiree uses deductions to lower taxable income. The IRS bill looks great, but the income number Medicare tracks doesn't drop the same way. 2 years later, premiums rise. Suddenly, monthly Medicare costs jump by hundreds of dollars, and nobody connects it back to that earlier tax decision. This is why people feel blindsided. Not because they did something illegal, not because they made a mistake, but because the systems don't talk to each other in a way that makes sense to everyday people. Now let's keep going, because we still haven't explained where that $47,500 figure really comes from, and who it actually applies to. So let's break down where that $47,500 number actually comes from, because this is where most of the confusion starts. That number is not a single deduction. It's a stacked effect. It comes from combining several tax rules that apply mainly to retirees. Individually, each one sounds ordinary, but together, they can shelter a surprisingly large amount of income from federal income tax. First is the standard deduction. For retirees filing jointly, this already removes a large chunk of income from taxation. Then there's the additional age-based deduction. Once you reach the qualifying age, the IRS allows an extra amount to be deducted automatically. No paperwork, no special application, just eligibility. Then comes how Social Security benefits are treated. Depending on your other income, a large portion of Social Security may not be taxed at all. For some retirees, up to 85% of benefits can be excluded from taxable income. And for others, even more can effectively disappear from the tax calculation when combined with deductions. Next comes interest income. Many retirees hold tax-advantaged investments. Some interest may not count toward taxable income in the same way people expect. When all of this is added together, the taxable income line on the tax return can drop dramatically. That's where the big number comes from. But here's the critical thing. Medicare does not look at that taxable income line. Medicare looks at a different number entirely. It looks at income before many of these deductions. So while the IRS sees a lower number, Medicare often sees a much higher one. Now let's talk about how Medicare uses that number. Medicare premiums are based on income brackets. If your income stays below certain thresholds, you pay the standard premium. But once you cross a line, even slightly, premiums jump. Not gradually. They jump in chunks, and these chunks can add hundreds of dollars per month. This is why retirees sometimes say, "I didn't even earn that much more." They didn't. But Medicare doesn't measure earnings the same way retirees do. It measures modified adjusted gross income. That includes wages, pensions, IRA withdrawals, interest, capital gains, and certain other sources. And crucially, it includes income that deductions later reduce for tax purposes. So the IRS might say, your taxable income is low, but Medicare might say, your income was high enough to move you into the next premium tier. Now let's talk about how this becomes a $300 per month issue. When Medicare premiums increase due to income, they don't go up by a few dollars. They jump. A retiree can move from the standard premium to a higher tier with one decision. And that higher tier can cost hundreds more per month when Part B and Part D are combined. That's real money, and it hits monthly. Now imagine this happening 2 years later. Because Medicare looks back, it uses prior year income data. So the decision that triggered this may not even be fresh in your memory. You may have already spent the money. You may have already felt good about lowering your taxes. And then the Medicare letter arrives. This delay makes it feel random, but it's not. It's the delayed consequence of how income was structured. Now let's talk about common triggers that cause this. One big trigger is large IRA or retirement account withdrawals. Even if you use deductions to offset taxes, Medicare still counts the withdrawal. Another trigger is selling investments. Capital gains matter for Medicare. Even if taxes are reduced, the gain still counts toward income thresholds. Another trigger is converting retirement accounts. Roth conversions are especially tricky. They can be tax smart in one sense, but costly for Medicare if not timed carefully. Another trigger is lump sum income. Things like deferred compensation, bonuses, or large distributions can push income into a higher tier for 1 year. That 1 year can affect Medicare premiums for an entire future year. Now let's pause here. This is where retirees often say, "So what am I supposed to do? Never touch my money?" Of course not. The goal is not avoidance. The goal is awareness. Knowing how decisions affect both taxes and Medicare allows better planning. Now let's continue, because we still need to explain who this actually affects most. and who doesn't need to worry nearly as much. Just stay with me. So who is most affected by this combination of tax deductions and Medicare premium jumps? It's usually retirees who are right in the middle. Not the very wealthy, not those with very low income. It's the people in between who feel it the most. These are retirees who planned carefully, saved responsibly, and now live off a mix of income sources. They might have Social Security, a pension, IRA or 401k withdrawals, some investment income individually. None of this seems extreme, but together, it can push income just high enough to trigger higher Medicare premiums. And that's what surprises people. They don't feel rich. They don't live extravagantly. Yet their Medicare costs suddenly rise. Now let's talk about retirees who are less likely to be affected. If most of your income is Social Security and you have very little additional income, these issues may not apply. If your income stays well below Medicare threshold levels, your premiums usually remain stable. If you don't take large withdrawals or realize big gains, you're less exposed. So this isn't universal. It's situational. Now let's talk about timing, because timing is one of the most powerful tools retirees have. Income taken in 1 year doesn't just affect that year. It can affect Medicare premiums 2 years later. That delay is critical. It means decisions made today echo into the future. This is why spreading income over multiple years can help. Instead of taking one large withdrawal, smaller withdrawals over time may keep income below key thresholds. This doesn't eliminate taxes. It smooths them. And more importantly, it smooths Medicare costs. Now let's talk about another mistake retirees often make. They focus only on federal taxes. They aim to minimize the tax bill this year. That makes sense. But Medicare premiums are a hidden cost. They don't appear on a tax return. They show up as higher monthly deductions from Social Security or higher bills. So people don't connect the dots. They say, my taxes went down, but my expenses went up. That's the trap. Now let's talk about Roth conversions specifically. Roth conversions can be a powerful tool. They move money into an account that grows tax-free. But the conversion itself counts as income in the year it happens. That income may not be taxed heavily due to deductions, but Medicare still sees it. So a conversion that looks tax-smart can still trigger higher premiums. This doesn't mean Roth conversions are bad. It means they must be timed carefully. Sometimes spreading conversions over several years makes a huge difference. Now let's talk about something else that surprises people. Tax-free income isn't always Medicare-free income. Some income sources don't increase taxable income, but they still count for Medicare. That's why retirees sometimes feel blindsided. They did everything right, but the system measures income differently. Now let's slow this down again. The issue isn't that the IRS is tricking seniors, and it's not that Medicare is punishing retirees. It's that two systems use different definitions of income, and retirees are stuck in the middle. Understanding that removes the emotional sting. It becomes a planning issue instead of a crisis. Now let's keep going, because there's another important piece we haven't discussed yet. It's about how Social Security benefits interact with all of this, and how small changes there can ripple into both taxes and Medicare costs. Now let's talk about how Social Security benefits themselves fit into this picture, because this is another area where small changes can have big effects later. Many retirees believe their Social Security benefit is a fixed number that only changes once a year. In reality, several things can slightly adjust that number. Cost of living increases, Medicare premium deductions, tax withholding elections. Individually, these seem minor, but together, they affect how income is reported and perceived by different systems. For example, when Medicare premiums increase due to income, they are often deducted directly from Social Security checks, so retirees see their monthly deposit drop. They may think Social Security was cut, but it wasn't. The benefits stayed the same. The Medicare deduction increased. This distinction matters, because the cause isn't Social Security policy. It's income-based Medicare pricing. Now let's talk about tax withholding on Social Security. Some retirees choose to have federal taxes withheld directly from their benefit. Others don't. This choice affects cash flow, but it doesn't change how income is counted for Medicare. That's another source of confusion. Lower net deposits don't mean lower income for Medicare calculations. Now let's talk about something very common. A retiree reaches a certain age and starts required withdrawals from retirement accounts. These required withdrawals increase reported income, even if the retiree reinvests the money, even if the money isn't spent. Medicare doesn't care how the money is used. It only cares that it was withdrawn. That withdrawal can push income into a higher Medicare tier. Again, not a penalty, just a rule. Now imagine this happening in the same year as other events: a cost of living increase, a small pension adjustment, a modest investment gain. Individually, none of these feels dramatic, but combined, they can tip income over a threshold. That's how retirees end up paying more for Medicare without realizing why. Now let's talk about thresholds themselves. Medicare income tiers are not smooth ramps. They are steps. You don't gradually pay more. You cross a line, and the premium jumps. This makes planning tricky. Being $1 over a threshold can cost hundreds more per month. That's what frustrates people. It feels arbitrary, but it's how the system is built. Now let's slow this down and talk about control. Retirees often feel like they have no control over this. That's not entirely true. While you can't control everything, you can control timing. You can control how income is spread. You can control when certain actions happen. This is where planning becomes powerful. Now let's talk about another misunderstanding. Some people believe deductions that lower taxable income automatically protect them from Medicare increases. They don't. Deductions reduce taxes owed. They do not always reduce Medicare-counted income. That's why relying on deductions alone can backfire. Now let's talk about the emotional side of this. Retirees often feel punished for saving. They feel like careful planning is met with extra costs. That feeling is understandable, but it's not intentional. It's the result of systems built at different times for different purposes. Once you see that, it becomes less personal. Now let's keep going, because we still need to talk about what retirees can do to reduce the risk of falling into this Medicare trap without giving up legitimate tax benefits. So what can retirees actually do to avoid falling into this Medicare trap while still using legitimate tax strategies? The first step is awareness. Knowing that Medicare and the IRS measure income differently already puts you ahead of most people. The second step is pacing. Instead of making large financial moves all at once, spreading them out over time can reduce sudden income spikes. For example, instead of taking one large retirement account withdrawal in a single year, smaller withdrawals over multiple years can keep income below key Medicare thresholds. This doesn't eliminate taxes. It manages timing, and timing is everything with Medicare. Another helpful approach is coordinating income sources. Many retirees pull money from multiple places without realizing how they stack. Social Security, pensions, retirement accounts, investment income. Each one adds to the income total Medicare sees. Looking at them together instead of separately helps avoid surprises. Now let's talk about charitable giving. For retirees who give to charity, there are ways to do it that reduce income in ways Medicare recognizes. This doesn't apply to everyone, but for some, it can lower reported income enough to avoid a premium increase. Again, it's about structure, not sacrifice. Now let's talk about filing status. Changes in marital status can dramatically affect income thresholds. Widowhood, divorce, or marriage can shift how income is measured. A strategy that worked one year may not work the next. This is why retirees sometimes feel blindsided after a life change. The rules didn't change, their situation did. Now let's talk about something people rarely consider: one-time income events, selling a home, receiving an inheritance, settling a lawsuit. Even if these events feel non-recurring, Medicare still counts them. That means a one-time event can raise premiums for an entire future year. Planning around these events matters. Sometimes delaying or spreading them can make a difference. Now let's talk about professional advice. This is one area where generic advice often fails retirees. A tax strategy that looks perfect on paper may have unintended Medicare consequences. That doesn't mean advisors are wrong. It means retirees need advisors who understand both systems together. Taxes and Medicare are connected whether we like it or not. Now let's slow this down again. This video is not telling you to avoid deductions. It's not saying the IRS is tricking seniors. And it's not saying Medicare is broken. What it's saying is this: big tax savings can come with hidden costs if income planning ignores Medicare rules. Understanding both sides allows smarter decisions. Now let's revisit that headline one more time. The idea of a $47,500 senior deduction sounds incredible, and in some cases, retirees really do shelter that much income from federal taxes. But that number doesn't exist in isolation. It sits inside a larger system, and when that system isn't fully understood, retirees pay in ways they didn't expect. Now let's keep going, because we still need to talk about how retirees can respond if their Medicare premiums already went up, and what options exist after the fact. That's an important piece many people don't realize they have. If your Medicare premiums have already gone up, the most important thing to know is this: you are not always stuck with that higher amount. Many retirees don't realize there are appeal and adjustment options built into the system. Medicare premiums are based on income from a prior year, but life doesn't always move in straight lines. Income can change suddenly. Retirement, loss of a spouse, reduced work, one-time financial events. Medicare recognizes this. If your income dropped due to certain life-changing events, you may be able to request a review. This is not automatic. You have to ask. And many retirees never do, simply because no one tells them. These life-changing events can include things like retirement or reduction in work, death of a spouse, divorce, loss of income-producing property, employer settlement payouts ending. When one of these applies, Medicare may adjust your premiums downward. This doesn't undo the past, but it can reduce future monthly costs. Now let's talk about timing again, because this matters. Medicare looks back 2 years, so when premiums increase, retirees often think it's based on current income. It usually isn't. That delay creates confusion, but it also means that if income dropped recently, you don't have to wait forever for premiums to reflect that change. You can request a recalculation. Now let's talk about another misunderstanding. Some retirees think appealing means arguing or fighting. It doesn't. It's a formal request to reconsider income based on updated circumstances. It's paperwork, not confrontation. Now let's talk about why so many people miss this option. The notice arrives. The premium increases. People assume it's permanent. They adjust their budget and move on. But in many cases, it could have been reviewed. Now let's connect this back to tax planning. This is why planning in advance is so valuable. Avoiding income spikes in the first place is easier than fixing them later. But even when things don't go as planned, options still exist. Now let's talk about one more common situation. Many retirees intentionally take higher income early in retirement. They do this before required withdrawals begin. This can make sense, but it can also trigger higher Medicare premiums temporarily. Some people accept that trade-off. Others don't realize it's coming. The key is knowing the consequence before making the move. Now let's slow everything down again. The big lesson here isn't fear, it's coordination. Taxes, Medicare, and Social Security are connected. You don't need to master every rule. You just need to understand how they interact. When you do, that $47,500 figure becomes context, not a promise and not a trap. It becomes one piece of a larger picture, and that picture can be managed. Now let's keep going, because there is still one major area we haven't discussed yet. It's about how future tax changes and aging into later retirement years can make this issue even more important, and how to stay ahead of it instead of reacting to it. As retirees move deeper into retirement, these interactions between taxes and Medicare often become even more important. Early retirement years are usually more flexible. Income sources can be adjusted. Withdrawals can be planned. But later years bring more fixed requirements. Required withdrawals become mandatory. Healthcare needs increase, and income choices become less optional. This is why decisions made in your early and mid-retirement years can shape costs later on. Not just taxes, but healthcare costs too. Now let's talk about required withdrawals specifically. Once required withdrawals begin, income becomes less flexible. You don't get to choose whether that money shows up on your income report. It does, and Medicare counts it. That means retirees who delay planning until required withdrawals start off and feel trapped. They say, I didn't change anything, but my costs went up. In reality, the system shifted around them. Now let's talk about future tax changes. Tax rules don't stay the same forever. Thresholds move, deductions change. But Medicare income brackets don't always adjust in the same way. This mismatch can widen over time. A strategy that worked perfectly 5 years ago may become less efficient later. That's why periodic reviews matter. Not every year, but at key moments. Major birthdays, required withdrawal ages, large financial changes. These are moments when small adjustments can prevent big surprises later. Now let's talk about couples, because this gets even more complex there. When one spouse passes away, income thresholds change. Household income may stay similar, but filing status changes. Medicare thresholds for individuals are often lower, so a surviving spouse can face higher Medicare premiums even without an increase in income. This is one of the hardest surprises retirees face. And it often happens during an already difficult time. This isn't a flaw in planning, it's a structural issue. Understanding it ahead of time allows families to prepare emotionally and financially. Now let's talk about why headlines like this one spread so quickly. A large deduction number sounds exciting, and it is real, in context. But headlines don't explain context. They don't explain interaction effects. They don't explain delayed consequences. That's why retirees feel misled, not because the number is fake, but because the full story is missing. Now let's bring everything together again. There is no single senior deduction check. There is no automatic $47,000 benefit. There is a system where multiple rules can dramatically reduce taxable income. And there is a separate system where income still affects Medicare premiums. When those two systems are not coordinated, retirees pay the difference. The good news is this: nothing here is sudden, nothing here is secret, and nothing here is designed to trap people. It's complicated, but it's manageable. The retirees who do best are not the ones who avoid income. They're the ones who plan income thoughtfully. Now let's keep going, because there is one last important concept to understand. It's about mindset. How retirees think about income, deductions, and healthcare costs can either create stress or create clarity.